Nice weather, very warm. Um, Yesterday we had a good time on Twitter. A lot of good tweets flying around. Thanks to George, who's not going to be with us for starting all the chaos. And then I wanted to know that. Well, he was basically saying something like, "How long would we stick with trend following?" So that's a good, it's a good topic. And then I was like, "Can we even trust historical performance returns with buy and hold?" I like, I tout the high sample size, trend following, breakout, few parameters, one entry, one exit, a stop loss that can yield thousands of historical trades, a high sample size, hopefully. And and then here comes the S&P with its, and I don't really have that much respect for this idea that the S&P 500 index is somewhat of a trend following index. It can never go flat. It can never really reduce its size very much. It kind of goes down in price. A breakout. So it's haphazardly, I don't know, doing some sort of trend following, but I don't think that there's much to it. And I don't think that's probably why it has worked so well. And then another issue that I wanted to hopefully get Richard to chat about was his tweet about the benefits of having a multi-advisor trend following fund, multiple trend following CTAs in one fund. That I didn't really understand how wonderful that could be, but his tweet made it sound like it was pretty amazing. So, and what other topics you want to talk about? Let's just get into it. Raise your hand, if you want to talk, and if I don't, try to pull you up on stage.
Hey Jerry, hi everyone.
Good morning.
Just one thing that crossed my mind while I heard you right now about the S&P 500 being a trend following strategy or not. I would put it in this terms. When we think about trend following, we like to cut our losses and let our profits run. Perhaps S&P let its profits run, but it never cut its losses, not quick enough. So in this way, it cannot be understood as being part of the trend following community.
Hi to everyone, hi Bruno, hi Jerry, hi to all, and I'm always happy to be here and happy now. And today I'm happy in a double way because I see Niels here, and it makes me really to feel happiness. I want to say about SP 500 that the words of Niels was a very good words of Niels about stock market, about equity. That from for 14 or 15 years, from 1960 till 1974, 75, stocks did not have any movements, did not have trends. So we can't. If we see only this movement, this trends last 20 years, it does not mean that it will be next 20 years. So without a diversification, we can't think that something is a very good instrument. Only one instrument cannot be good for be a perfect trading instrument.
Yeah, I hate to see these studies. A lot of anti-trend followers on Twitter or wherever, they will put out a study, back test of the S&P index and trend following that index. And I don't, obviously I don't think that's a good idea. I would still love to see that back test of all 500 S&P stocks individually, long-term system, and see how it does. And, there'd be some challenges with the change of constituents. And then what do you do with the short trades? How do you size it? But I think a traditional CTA money management scheme with maybe some leverage and maybe just trading the 100 biggest stocks would probably do pretty darn well. Um, with trend following, but it begs the question that do we have data? I mean, Niels, I like Niels's tweet in that we don't have faith. We have faith in data, and so the question is 1,000 years of S&P returns, which is just never liquidating, basically just what's going on inside that index. Is that the type of back test that we can say we have data and we have some evidence, like we say with a 5,000 trade back test and trend following, um, and of course, in our opinion, or I think the data would show that over the entire test period, not trading things other than just stocks is going to improve the performance, obviously. And
Unfortunately, I saw a lot of people who think that trading in a forex market is not very serious, and trading on stock market it's a real serious trader job. And people don't understand the power of this diversification and the importance of the diversification. And as usual, they don't talk about commodities at all. They talk about only stocks and about only forex. And I mentioned that if a person is talking about forex only, he usually does not understand anything about trading at all. He is a very young trader, and so if person talks about only stock markets, he knows a little bit more, a little bit, not much, but he speaks in the way that he is a serious investor or something like that.
First of all, let me just say hi to everyone. And also, I think it was great to see yesterday that George, by sending out a single little tweet, could get everyone sort of to dive into the conversation and defend what we do. Um, but I just wanted to add one thing because I obviously he was doing it sort of tongue in cheek. He does like trend following without a doubt, but he's also sort of questioning some of the things that we say and some of the things we do, which is absolutely fine. And I don't know if this really fits into the discussion as such, but I also think we sometimes forget that the edge of trend following, or the advantage we feel we have, and that the data shows, is possibly a very small advantage in each market, so to speak. And that's why it can it can take a long time for us to show it can take a long time for it to show up. We can go through these very long periods where it looks like trend following doesn't work, and then suddenly it works really well for 12 months or whatever it might be. So I think that's part of the discussion. We have the data to support it long term, but we also have to recognize that it doesn't work all the time, and that the edge, so to speak, not the edge in the data necessarily, as Rich's research shows, but just the edge overall is possibly quite small, which is why, as Jerry and Moritz always say, we need lots of trades, we need lots of a big sample size.
I love this discussion about the sample size and the way we test our models. And recently I've been struggling with two ways of looking at our back tests. One is looking trade by trade, and I think even that this was a topic talked about in Neil's podcast, you guys' podcast actually. And one way is to look at on a trade basis, trade by trade. I can compute its return and calculate statistics based on it. Another way to look at is on the return based on time, and this is what's behind a lot of these factor models or momentum models or what have you. I have difficulty looking at on this second way. I find it really hard to understand what's this. How can I tell what's the sample size of this second way of looking at things? Because on the first way, I can look at how many trades I've made, and that's my sample size. My back test has, I don't know, thousands of trades there inside, and I can say, okay, my sample size is thousands, and I have a roughly idea of what's the average return, what's the skewness of the returns, and so on. But when I look on a time basis, what am I looking at actually? Am I looking at the average daily return? How can that be any informative of what's coming next? What do you guys think about it, about this topic?
Hi everyone, great to be here. That's a good point, Bruno. I think we've got to shy away from this notion of time because our trend following models are looking for these unusual sort of outlier events which they don't sort of line up in a sequential sequence. They're haphazard, they're non-predictable, and they occur whenever. So I tend to sort of adopt your view that the trade history is the most important thing to look at. If you look at things like on a time basis, such as the monthly returns, etc., things such as skew automatically get diluted when you look at it from a monthly basis. But when you look at it from a trade by trade basis, the statistics that we sort of use, such as skew and the MAR ratio and all of these things, they tend to be more informative and more sort of accurate in relation to trade activity. And sometimes, in 2008, we might get a large sequence of events occurring within a short period of time that are all fairly highly positively correlated. We get these massive outliers and we get these fantastic returns in a very short period of time. So our wealth is attributed to these unusual events. And really, when you look at the entire life cycle of a trend following fund, it's the number of these events we get as opposed to when and where they happen that's most important as far as I can tell.
I think it's a very interesting, almost philosophical question because we live the day-to-day returns, but the end result after a career will be the sum of all of our trades. And of course, if you're trying to disentangle, the factor returns or something like that is one thing, but also it's something your investors are looking at. And if they're comparing you to a benchmark, I mean, that's really what they're doing. So I would say part of that aspect is also just the environment of the clients and the industry. But I do think that the return series is important. It does contain information and it will help you get a better feel of what's the day to day like. You can use it to risk manage, and your edge should appear in both. If you have an edge in the individual trade distribution, you will also have an edge in the daily return or monthly return distribution as well, although slightly transformed because they're in different spaces and you might have multiple trades on each day and they might last months or years. But in the end, we're the aggregate of both. We're the aggregate of all the trades we've taken in our career and all the days that we've had positions on for our track record.
That's a good point, Derek. I agree with that. One of the things I thought of, though, is that overly concerning yourself with the returns of all the trades, daily, weekly, monthly, whatever, versus the trades themselves, like Bruno mentioned, is that it can tempt you to do bad things. So your edge should show up, and that's great. I'm looking at it. That's fantastic. Good for me. My trade stats look great. My daily, weekly, monthly, annual performance numbers look great. But I think when I first got into the business, got confused when I would notice a lot of other traders talking about trading in terms of the returns, and I was like, whoa, 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 no, that's not good. And but I think that their motivation was, well, we want to make it sound more like what clients would be used to. We want to vol target. We're not going to let our profits run. We have no intention of viewing information with just trade data, entry, exit, and look how much money I made. Well, what happened between the entry and the exit? There was a a lot of volatility, a lot of drawdown. So I've got to dig in there and get rid of that as well. And so I think that in order to put yourself in a situation where you're going to use vol targeting, you're going to use Sharp, you're inevitably going to choose to look at the returns versus in terms of the percentage returns. And then they go so far as to talk bad about the skew and the outliers and the non-normal distribution, and we got to get rid of that as well. So then you're never land, and you're not trend following. Oh, I put out this rude tweet, about European CTAs, and no one called me out on it. It was so I was just sort of joking about the fall targeting and all the things that you're tempted to do to maintain your asset, your AUM, and to earn the management fees and to keep your clients happy. And the next thing you do, you wake up and you're not really trend following any longer. That, my opinion.
I think it's a very dangerous situation for the trader because I have talked about this many times, and I'm saying it again, and I'm going to say it again, that we must think about following our rules, and these rules must be based on trend following classical principles. We are trend following here, almost all of us, and it's the main things. And if we are thinking about investors' opinion, with a very high probability, we will lose money because investors, most of them, have, as I have seen this, at least, they have a mentality of a young traders, of a traders that only beginners, and of course there and as Neil said, as I remember that trend following, or maybe Jerry, I don't remember it's exactly, but that trend following rules are often counterintuitive. And so people who don't understand this, they will don't understand what we are doing, and they will think. And so, but we must not to do something to please them. I think that when they will see good results in maybe 3, 4, 5 years, they will invest money anyway when they will see trend. And so if we will be in a trend like this year in commodities, they will invest money. If we are in a drawdown, of course they will take their money back, because as I wrote it in Twitter that they want consistency, but they are the most maybe inconsistent guys in the world. When I'm in a drawdown, they take money back. When I'm in a good, my performance is good, they give more money. But this strategy is not good at all. It's not a very good idea to be inconsistent in the market. And I'm saying this because I want to say that we must only follow, as I said before, we must only follow our good trend following rules. And listen the best experts in the field, like Jerry, like Maritz, like Niels, but not investors' opinion.
Let me just add one thing, maybe, and I mean, I think this is what George was getting at yesterday in his first tweet, and I think it ties into what also you just said, Jerry, and that is, yeah, we tend to look at trade stats, and that's great. The question is, over how long period do we look at them, but also do we look at changes in trade stats? So, for example, if our trade stats for the last 3 years is very different from the full length of our data, does that alert us, concern us, whatever it might be? And whether you look at trade stats or whether you look at performance, they should kind of be correlated, right? So if performance is bad for 3 years, probably the trade stats will be different than they used to be. So I think that's what he's sort of also coming at a little bit is, at what stage do we say, okay, something may have changed?
And our dilemma is our performance is dominated by the outliers, which are outliers, which we're not going to see very often. And so it's dangerous for us to take into consideration 3 to 5 year performance, maybe even 10-year performance, and say, oh, I'm not getting the outliers, and so something is broken. I mean, the system is not necessarily broken. It's broken if you have outliers and you didn't profit from them. I mean, honestly, if you didn't profit from the soybeans and the oil and the meal and the corn, you probably have a problem. So, but that's sort of the dilemma, is when do you give up on a systematic approach that is dominated by things that don't happen very often. And like you've said, we had probably a 10-year period where the grains didn't do very well. And then that's why we sort of say, well, it's so imperative with this strategy to trade lots of commodities, currencies, bonds, stocks, because we're hunting for these rare events, and we're expanding our opportunity set.
I think that's a great point, Jerry, and I think that's absolutely spot on. And I also think that that's actually why you may be able to say that we do have some level of faith in not just the data, as I was saying in my tweet, but actually we have also faith in the underlying process of what we do, regardless of whether it doesn't work well for 5 years or not. We actually think what we do makes common sense. As you say, we hunt for the outliers, we're waiting for the outliers, and when they show up, we'll be there for the kill. So it's kind of a combination. I think deep down, you have to believe in the process in addition to the data.
And I have this belief, this faith in the process, in the trend following process, because I see, as I said before, the trend following process in general in many things in our world, and even in temperature charts, I can see that if winters come, we have a downtrend on the temperature. If a summer comes from the spring, it is up chart. So I see that it's a law of nature that big changing in the something, the process where we see the big changes is the law of nature. And also, of course, it's the law of people behavior.
I have been thinking about something that's related to this a lot recently, which is the concept of finite games and infinite games. Kars wrote a book about it, but basically, I believe that most of the clients and the people on Twitter are playing finite games, and they consider their returns at the end of the quarter, the end of the year, or their career for investing in you as the end point. But we, as trend followers, are playing an infinite game, as in we try to survive for as long as we can. We cut our losers, we let them run. What that lets you do is to continue to survive these down periods, because I think what Neil said, having faith, we have faith in the underlying principles of what we see in financial markets, which is they are not normal. They do exhibit outliers. We don't know when they will come, but as long as we can survive, we can get there. And that's why sticky money is so important, is because those are the people who are also playing the infinite game. The guys who are, as Oleg mentioned in his for himself, that when people are, going in when he's making money and taking out when he's not, those people are playing a different game, and so they have a different perspective, and they usually have a higher risk tolerance because they're trying to get that reward at the end of that period.
That's a good point, Derek. We're playing Go, we're not playing chess. Look, in relation to trend following, we sort of have ourselves against the back foot when we sort of compare ourselves to these alternative methods that are sort of generating cash flow as opposed to sort of long-term returns. So one of the things I think is extremely important is that I actually feel that it might take thousands of trades before we can definitively conclude that our models are working, simply because of the nature of noise and randomness on our return streams. And it's only when we get these significant nonlinear outliers that we truly see how those prior sort of random returns amounted to nothing in relation to what we can achieve through our performance. So I think it's critically important we use benchmarking as a process to validate our performance. In other words, there will be periods where we should expect to have stagnation or drawdowns over 3 to 5 year periods. We've seen this in history. This is a very common happenstance. But through benchmarking against other trend following funds that are all sort of classically aligned in the same way. So we can group them as characteristic trend following funds. Benchmarking allows us to determine whether we are underperforming or overperforming that particular benchmark. That is, I think, a much more powerful method of determining our performance, as opposed to, for instance, considering a sample size of a year as being indicative of our overall performance. We can't do that. We need 20, 30 years to actually demonstrate how our method of playing Go actually works in the long term. And to give investors confidence, I think if we used a benchmark, not the Societe Generale or the B Top 50, I think they're inappropriate. I think we've got to develop a better benchmark for classic trend followers to firmly sort of categorize a particular style of trading methodology, and we're very transparent about that style and we can classically fit within that grouping. Then a benchmark is our way of evaluating our performance.
How about 40 in, 20 out?
Well, I don't like 40 in, 20 out. It's too short term, and it seldom works for a long period of time. But longer term stuff has a tendency to do much better, and to do much better over the time period where 40-20 might have done well. Because I traded 40-20, but when I did my research and abandoned those type of parameters that are too short term, I found that longer term parameters had always been better than 40-20. I mean, I did a back test recently, and I think it went back to 1977, and it was just one of the systems that I trade, and it's very simple. It one entry, one exit, and a stop loss, and it was shocking how good it was. And literally, I mean, I know the drawdowns were large, but in all of those years, it had a couple of small winning years that probably would have turned into losses, possibly given a real-time trading. But the back test showed no losses since 1977. And I think that's what I want to achieve, which is sitting with my trading could be hell, but we have a large likelihood of making money almost every year.
Oh yeah, no question about 40 in, 20 out being an inferior strategy. I'm just saying that maybe that's what could fit the benchmark that Richard's talking about. It's simple, it's intuitive.
I was actually thinking more of just grouping classic trend following funds into one index and using that as a benchmark measure. So we've already got a history of long-term track record of these classic trend following funds. For new funds that enter the industry, they can benchmark their performance on an ongoing basis against that benchmark, and that's a way for investors to then sort of evaluate whether a particular performance return of a fund is above or below the benchmark, and that's how you write your investment letters to your investors, talking about your performance in relation to the benchmark and why you're outperformed or underperformed. It just gives a clearer way to express the approach we adopt, rather than relying on this continuous ascent of the equity curve, which is unrealistic within our particular technique.
And I want to mention here words of Maurice about investors, and he said that, with his opinion, he said that wishing a lot of smooth to investors is very risky behavior, because it's a lot of hidden risk. And the second one, we don't need to please everyone, investors, he means. We manage money for those investors who like what we do. And now I want to mention the words of Niels, very important words of Niels. about investors, about attracting money, raising money. He said that best people in raising assets are people who are very clear with their communication. Tell investors what you do, why it works. Instead of complicated explanations, keep it very simple but clear. It works best of winning the trust of investors. Okay, very good word.
Thanks, Oleg. It's the loose pants fits everyone type of thing, right? They don't look nice, but they work. And most investors, they want the skinny pants. They want the stuff that's fancy and modern and very smooth. And they overlook that you can get that to an extent through diversification, but that's not enough for them. They want it Madoff smooth, right? Otherwise, they're not happy, and so the investment managers, they do everything to please their clients and make those return profiles as smooth as they can. And for the most part, they bake a lot of risk into that smoothness. There are the exceptions, right? There are some probably very good hedge funds who crank out returns of the market that neither you, I, or probably anyone on that call here can do. They're not trend followers. They do different things. Maybe they make markets and they're high frequency traders, but that's not what we do. But a lot of those people that have these super returns and very high Sharpe ratios, they're closed. And why would they open their business to anyone, right? They enjoy their strategies with their own money and they don't share it necessarily with other people. Case in point is Rentec. So, but like I say, for the most part, it's a lot of hidden risk, as you've alluded to, and that risk is, in almost all cases, a downside left-tailed risk. It's never to the upside. It's always a downside risk, and I've seen it actually in action a couple of times when looking at other managers. They have a strategy that is, say, momentum based, or they do something in the commodities and whatever it is. But then all of a sudden you see that they're using options and they're selling puts against their positions, and this is where you start, right? Sometimes selling puts can be a very, very good thing, but if you do that systematically, only to generate an income to smooth the returns, and you're willing to, run the risk that eventually, and it will happen at some point, you're going to be down 50% on just that position. That is just bad trading, really bad trading.
Yeah, that's why they can classify these retracements and drawdowns in mega profits as losses. That's another thing. We got to classify this as a loss. And I'm so baffled. Like, wait a second. I take small losses. I have a stop loss. I have a trailing stop. This is not a loss. No matter what happens in corn today, if it's down limit, I'm not going to have a loss in corn. That is a mega profit. And so the capturing of the language, they say that in politics, let's take the language and turn it into something else. And I think sometimes we have to stand up and say no, that's not the language. This is not a loss. There's no such thing as a trailing stop loss. No. It's a trailing stop, trailing exit, breakout exit if you own a profit, and then there's a stop loss where you risk 25 basis points, 50 basis points, 1%, whatever you want to do. And so I think staying faithful to this language, and I would just notice this over the years, that the language started to change, that yes, in fact, drawdowns are losses, from drawdowns in mega profits are losses. And I was like, no. Look at the daily returns, the monthly returns. No. Look at the trades. But there's all this information you're losing with what the trade is doing in between the entry and the exit. Well, true. But you know what? I'm letting my profits run. I'm trying to close my eyes and nail this mega profit, nail these outliers as much as possible. That's how I like to evaluate my system. When I have this opportunity, did I crush it? And I'm famous for saying think it's total success to make the most amount of money on a certain trade. And at the same time, you might have the largest drawdown as well. No one made more money than me. No one had a drawdown larger than me.
I like these words very much. I appreciate really these words because for me, maybe it's only philosophical aspect, but when I lose money in a systematic way, I don't think that it's a loss. It's a part of a game, part of a trading process. And of course, I like it because I like a trading process in general. And I think it's not normal to like only when you are in a profit and don't like when you're in drawdown, and we must to avoid this type of thinking, and the drawdown is a necessary part. And another part of this is that we must have a very good risk management rules and a very good sample size and very good rules. Of course, we must understand what we do. Is then the next part of this.
I remember in a tweet you said that you don't really agree with me 100% on my carefree attitude about open trade drawdown.
No, I was firmly in agreement with you about so this is what I was saying about drawdown. What I was saying is that we were initially talking about the need to use realized balance as our basis for position sizing and risk allocation, etc., as opposed to equity, which includes the unrealized equity. And then someone mentioned about, but drawdown's a risk. And I actually thought, yes, well, actually, we could apply an even more conservative measure to the realized balance to include the drawdowns, not the unrealized profits, but the drawdown components to actually reduce the realized balance when we are in drawdown. That would actually be the ultimate, most conservative position we could take based on known risk at a point in time, because there are times, it's rare that we find that our realized balance sits too far away from maximum drawdowns. But at the early stages of a fund's inception, it is possible, especially in that first year or that first 2 years as a fund's getting up and running, because it takes a while for the fund to actually achieve this positive skew, where then the equity is significantly sitting above the realised balance, and any drawdown is basically coming out of the unrealised equity as opposed to the eating into the realised balance component. So all I was saying was that if we were to adopt the most conservative position, we could actually say realised balance less drawdown, which inevitably in the second, third year, etc., the drawdown will be zero in relation to what I'm talking about is a drawdown from realised balance, not the drawdown at all times, the drawdown from realised balance. That's what I was meaning there, Jerry.
Oh, pretty good. Yes, I agree totally. In fact, I would just word it slightly different. And I think this is an outrageous statement that people need to research, do a back test, and see if you come up with the same conclusion. And I'm just going to repeat in my own way what Richard just said. But I've said this before, and nobody is outraged by it. I try to say provocative things so people will go off and say, I'm going to prove this guy wrong. But in all of our research, it's just like Richard said. After a year or two, the drawdown in the realized profit, the capital in your account, the initial equity plus the realized profits and losses, the drawdown in that number is always exceeded by the open trade equity. So someone could have, every client could have redeemed on every day, any day in the past 30 years after the first year or two, and would have had no drawdown in their capital account. Zero. There's no drawdown at all. So this is what we found. And yet you have to convince yourself that part of this trend following approach, taking small losses, letting your profits run, you're going to buy into it and you're going to say, hey, wait a second, it sounds like you're not paying that much attention, if any, to the open trade equity, the open the open trade profit in all your positions, open positions. This kind of scares me, but I think if you do that, you kind of get incredibly rewarded. Richard, do you want to explain your tweet about, or were you sort of, is that what you were talking about earlier about a good project being a multi-advisor fund of CTAs, trend following CTAs, and I forgot the how that tweet went, but there was a little bit more to it than that. You were sort of extolling the virtues of this strategy, but I thought beyond just using it as an index.
Yes. So look, what I was saying is that it would be even better in relation to achieving even broader diversification if we could allocate across multiple trend following firms as opposed to allocating towards one. So I actually find that in my research, when there are methods that we can adopt without using hindsight bias, where we can invest across multiple trend following CTAs, for instance, with a long-term track record, and achieve exceptional net wealth at the end of the exercise, with potentially lower drawdowns as well through the sort of uncorrelated benefits you achieve through the allocation into a sort of a more diverse portfolio of trend following CTAs. That's all I was saying there, Jerry. It's a bit like saying, okay, if we invest 100% in Chesapeake, we get all of the diversifications of Chesapeake. But if we invest, 25% in Chesapeake, 25% in Dunn, 25% in XYZ, we achieve even broader diversification benefits. And really, sort of my whole basis for being is this assumption that, well, diversification, whilst it is very good to sort of achieve sort of uncorrelated relationships within a portfolio, it's even better with broad diversification to catch these outliers. And with such broad diversification, you'd certainly catch those outliers.
Yeah, you brought up a good point there, Richard. Now, just to play devil's advocate on that, it would this goal of all of this diversification amongst Dunn, Chesapeake, Niels, Moritz, and Richard. We all get 25% of all the trend following money out there.
Thanks very much, Jerry.
That's
I'll just give you my checking account now.
That's right. That's a very good idea. But, it does sort of give me the impression that this is within the grasp of any one of us. And so here's the dilemma. If we had this knowledge, if we all had the sufficient knowledge that was in the other three firms' heads, and we agreed that, okay, this is not too short term, this is not too long term, I'll trade those systems. And I'll trade all the markets, because some of the performance difference will come from the fact that some people don't trade all the markets. Well, that's a no-go. I know it's going to add diversification over in some months, but we believe you should trade more markets, not fewer, not stocks only, or not overweight stocks or overweight currencies. So I think I think this whole idea is within our grasp, but only if we had this sort of knowledge and smarts about how long-term should we be, how short-term should we be. And we're able to expand our universe of systems and markets and encapsulate what the other three firms are doing, but then not do the things that the other three firms are doing that we think are wrong. So it's really, we're kind of punting on this idea of, let's get serious about what we should and shouldn't do in trend following, which markets we should and shouldn't trade. One firm can come up with it's not just a question of this broad diversification, it's a question of doing it all correctly. And this is because we're sort of like saying, I don't know what this other firm does, but I'm going to add them anyways, where the fact may be over the long term, we maybe shouldn't have added that fourth trader or 99th trader, because if we got to look inside of what they were doing, we would disagree with some of the things that over shorter periods of time would say, hey, that's great, that's diversification. Over long periods of time, we'd say, oh, we shouldn't have added that trader.
I think that it's a very good idea to trade as much markets as we can, but I think that we must have common sense here. And as I know from Systematic Investor Series, that it's optimal to have maybe 60, 70 markets in a portfolio. It's optimal and it can be enough, because It's a market correlation problem can be, and if we have 200 or maybe 300 markets, it can be even a problem because it's maybe too much diversification. I think so.
Look, I'd disagree with that. I don't think you can ever get too much diversification in the particular space we're concentrating on. What I'm talking about is, I'm not talking about just allocating towards any trend following fund. What I'm saying is that there are a particular class of trend following funds who've got a 20-year track record. They're highly transparent. Of those funds with a 20-year track record that are highly transparent, when you actually compare or map their equity curves against each other, you can actually tell whether they are applying the trend following recipe or not. You see that in their overall return profile and their equity curve. So when you actually then allocate to 4 as opposed to 1, it's a bit like when Moritz says any additional market adds a degree of a correlation benefit when you add that market in, even if it's a fairly high correlation. What we find with the using 4, for instance, trend following funds, you do get this correlation benefit because their timeframes might be slightly different. They're still trend following funds. You can see it in their curves. You can see that they're all achieving their outliers over similar periods, but it's the randomness in their curve. This is where it's very important that we understand that a significant component of our equity curve is random. And it's a bit like when you, for instance, collate multiple random return streams together, because each random return stream is actually, by definition, random, they are uncorrelated with another random return stream. And so what happens when you combine 4 random return streams together? You actually get destructive interference of the random returns and you get a flatter profile. You actually eliminate the randomness in those return streams. The signal or the outliers that you're catching all amplify. So you actually get a significant correlation benefit when you're allocating towards 4 trend following funds as opposed to putting 100% of your investment in 1.
I agree with this because when we are talking about the phones, I agree with that. It can be strategy diversification, it can be time frame diversification, and of course it gives a lot of benefits, diversification benefits in general. But I talked about that if we must have as much uncorrelated return streams as possible, and it's a key to be a very successful trend following trader. But if we take say 300 markets and 100 market from or maybe 80 market are high correlated to each other, and it can be there are maybe not much benefits from it for trading for individual trader, I think so, because of these correlations. And I meant this, but not that we must invest in one fund or something like that.
I'm not sure. I don't want to misunderstand your point, Jerry. But I actually think I agree with both sides of this in a sense that you were saying, Jerry, that it would be if we look at some of these other funds that you might allocate to, and we might look inside them and say, no, we don't really agree with that. So if the starting point is that, sure, they're all classical trend following funds, so they're not doing anything other than that. I think the only thing we achieve, and that goes back to Moritz's point, is what we can achieve by that diversification to a large extent is smoothness, right? We can smooth out the returns. It doesn't really mean we're going to get a better return at the end of the day. But I would agree that diversifying across different types of trend following, diversifying different markets, timeframes, etc., most likely it's going to give us a nicer ride, but it doesn't need to be, or I don't think it will be the best ride, because one of those 4 will probably over a 20 or 30 year period do better than the others.
Yes, and I agree with all of that and with what Richard said. I guess my main point was um, some of this increase in diversification is at we could achieve this in our own firm to make our own trading better if we traded more systems and maybe expanded the look back period a little bit longer, a little bit shorter term, and then everything in between. So that's what I'm sort of saying is that to a large degree, if we had better knowledge and more smarts, or we understood, we could possibly stay within the classical trend following in our own firm and expand things, add more markets, add stocks. Um, we'd go a long ways towards making our own performance look better prior to becoming part of this multi-advisor CTA trend following index and fund.
Which is exactly what I think groups like Man Group have done. I heard Sandy Retaillew talk about, and I think he talked about Man as a whole, not just AHL, but they're up to 700 different models. And we know they trade probably more north than 300 different markets overall, right? So they're doing exactly what you're saying, Jerry. And I think it shows up in their returns. They are never the best, but they're never the worst. And they're doing a pretty good job, frankly. So I think you're absolutely spot on, Jerry. That, in a sense, is probably what we should do if we want to manage the big amounts of money. Alternatively, we can do what someone like Paul Mulvaney is doing: stick with what you've always done. You're going to have a fantastic returns over time. You're going to have larger drawdowns than perhaps others, but it works. It may not be exactly the most client appealing, return stream, but it truly works. So that's kind of the two extremes, I guess.
I think when we talk about the dispersion of returns, it's commonplace here that it gets smoother when you add models or add managers. But Richard, do you think there is reason to believe that the average return is of your portfolio is enhanced somehow if you add these other managers to a portfolio?
Look, what I do find, let's say, for instance, in a hypothetical example, I allocate 25% to the four trend following managers that have a 20-year track record. What I find is that the risk-adjusted returns of the composite significantly improve, and this is significant. So as opposed to a trend-following fund that might have a 50% return, a drawdown over that period, you might have a fairly good compound annual growth rate, which is lower than the compound annual growth rate of the firm with a 50% drawdown, but the total drawdown might be 25%. So what I then do is to say, well, let's apply a bit of leverage to this model again, and then I can lift those returns to achieve an even better return with a bit of leverage applied to the allocation method. So that would be, some form of margin loan facility or whatever, where you might allocate 60% of equity in with 40% of debt or whatever, and you can significantly go one step further in improving your net wealth with a commensurate drawdown of 50% over that period. The key thing here, though, is that you can't do this with trend following funds that haven't been sort of firmly tested and validated over a very long term track record, because there's always risk in the assumption of the manager unless you know or you're very confident in the capabilities of that fund manager in navigating uncertainty over that long period of time. So when you do apply a bit of leverage into these models, yes, Bruno, we can achieve a better result through an allocation method, but it's certainly it's just something to consider.
I actually think, Richard, you're right. Sorry, Bruno, just to jump in on that, what Richard said. I actually think to some extent that, Richard, you're right, and maybe you don't even have to apply extra leverage, because if we assume that four trend following firms has been around for a long time, let's just assume that their long-term return are pretty similar. Then actually you would think that because of the lower correlation between them to some extent, will keep you closer to your high water mark at all times, and that means that the compound effect actually should give you a better return over time. So I actually think, in a sense, Richard, you're right, and that you don't even need leverage. But I also think you can, if as Jerry said, we can achieve a lot of that ourselves if we were to just keep expanding, putting in good models, et cetera, adding diversification on time frames and markets, etc. So I'm kind of in both camps here.
Great point,
Yeah,
Niels.
the crucial point, I think it's the risk-adjusted returns you just talked about, Richard. In a way, it could be achieved by expanding our selection of models and increasing the unit size of each one. So this way, we are in a way applying more leverage and expanding our selection of models, our selection of lookbacks and etc.
Yes, the only problem is that a trend following fund is sort of governed by the mandate they've got to operate under. So if, for instance, you can gain exposure to China, you can gain exposure to broad geographic coverage, broad timeframes, very broad systems. Through this mix and match of this allocation method, you can truly achieve things that lie outside the mandate of an existing trend following fund.
But isn't this, Richard, exactly the reason why you get better results or different results? Because you're effectively leveraging off these different funds skill sets and alpha, other than the strategy itself.
Yes, look, this is theory, because we've got to also remember that there are mistakes in every trend following fund. And if you diversify across trend following funds, of course, the materiality of those mistakes reduce. But it's inevitable that over a 20-year track record, there will be some poor decisions made at certain periods of time in reality. This is a method to sort of eliminate the materiality of that. But yes, I agree with you.
I like that point. Yeah, that's a very good idea. So I was concentrating on all the great things that I do, but also the things that I do that are not so great, which I don't know about. They get minimized when I'm paired with other traders. I like that a lot. But my only sort of comment to what Niels was saying is that I just get the impression that some firms would take this idea and run with it away from 100% trend following. So 300 models, or that would be outside of our I doubt if man has 100% classical trend following. So I think that is kind of the problem with going crazy with this idea. There's only so much we can do. The classical trend following approach is very restrictive.
Yeah, I agree with you, Jerry. Look, the problem in the industry at the moment is we don't really have a dedicated 100% benchmarked classic trend following fund performance measure. I think the industry is crying out. Well, we're crying out for that. So, you'd have to make sure that each of the funds that applied these classic trend following rules, they didn't sort of flavour up the mix with pattern recognition and all of these other things that dilute the efficacy of our approach. So I think it's crying out for a need for some form of, classic trend following index, and to identify which are those funds that exactly accord to the recipe of a classic trend follower.
Jerry, isn't this kind of what Richard Dennis was essentially doing with the turtles at the time, whether he actually knew it or not?
That's the way it was supposed to go. I will have the turtles learn the basics, and then they will add their own flair, their own ideas. We'll backtest that possibly, and we'll get some massive diversification with all of these guys who know the basics, but they'll be so interested and so able to expand our knowledge base. But we were all thrown in the same room, and it became evident pretty quickly that everybody was going to start doing the same thing. I think if we would have been taught and then said, go back home, then I would have gone back to Virginia, and I think my trading would have started to be different because I wasn't listening and seeing everyone there doing what they were doing. And then there was politics as well. Who was getting rewarded? And so then people would say, oh, that person's getting rewarded, then I'm going to start trading like them. And so it didn't really achieve. But then in 1988, when everybody went on their own, everybody started looking a lot different. And the office was shut down. There was no more program. And now you can see that everybody's doing different things.
Hey guys, Avi here. Great to see everyone. Jerry, thanks again. Richard mentioned trend following index. I don't know if you've seen this, but Two Sigma has a product called Vensites. It's free, and they have a monthly newsletter that they shoot out that has trend following as one of their hedge fund styles that they track. So they don't go into detail of how it's actually composed, but that's out there for anybody that wants to look it up. So you just Google Two Sigma Venn Insights, Venn Sites, excuse me.
Thanks, Avi. I'll check it out.
You know, I'm thinking about this kind of CTA super friends or becoming the jack of all trades, and on the opposite side, knowing your niche, because I think that's what it's all coming down to. Yes, a diversified portfolio is going to, stabilize your returns, which allows you to apply more leverage because in the end you should be increasing your Sharpe ratio or however you want to think about optimization. But what I really think on the other side of that is how are you going to market yourself? If you stick to what you do and you know your niche, whether you're a long-term trend follower or a short-term trend follower or medium term, or you have some different systems other people don't have, is attractive to clients unless you do become that man group whereby you are always mediocre all of the time and clients will know that's what they're buying. So I think that it can become more difficult if you just everybody tries to become the jack of all trades, and then it will almost swing the other direction. If you do have your niche strategy, you will then start to get more allocations because you're doing something a bit different, and then you will be the one providing the diversification to the portfolio of these, say, jack of all trades trend followers.
I love that. That's exactly right. And I think that is another thing that investors are crying out for is what is some consistency, what to expect. And when the industry went to vol targeting and paying attention to returns and volatility and away from these are crazy guys who trade all these different markets, they have a lot of volatility, they're very consistent, they add diversification, they're committed to commodities, then it worked for some people to take trend following and adjust it in a way that was going to be more palatable to people who don't like trend following, which was totally unnecessary. Here you have the world's most popular investment that makes about 8% a year with over a 50% drawdown many times. The bar is so low. There's not a CTA in the world that can't. There's no way to if you target 8% return, it's almost impossible to have a 50% drawdown. We have too much diversification. We have shorts, we have rules, we take small losses. You can't be as bad as the S&P index. And so rather than just prizing consistency and transparency, we up the game against ourselves for no good reason. And then we can't even beat the S&P sometimes. And people have no idea what they're getting. They're not getting this process and systematic process and trend following. They're getting the smarts of large firms that have PhDs that may use a bit of trend following, and sometimes they fall on hard times for obvious reasons.
I want to bring up a different point because I think we understand what's the situation in industry from this discussion and how potentially we could either become more unique or more all of the same. But what is everyone's process for continual improvement? Or is there a point where I'm doing exactly what I'm supposed to be doing? This is what I believe, everything is right, and then just freeze, everything. And maybe that goes back to what potentially George was saying in his tweet, but I do think that there's always room for improvement. The question becomes, how do you not lose your essence if you have carved out a niche, or what is acceptable avenues to improve your fund, your strategy, and yourself as a.
Yeah, that's good. I like that. I would just say that I think to a large degree, no one anticipates asking the S&P index to do that. And if we said, if it goes through these periods, it has a negative return for 10 years, like it did in 2008, no one's going to be saying, hey, you've got to change this thing. And so, well, but for us, we must be willing to change. So I'm just sort of saying we should be hesitant to change so much. I was watching one of Richard's videos the other day. It was an older one, I think. And I got to this point and I had to leave it. But he was basically going to tell us what we had all been doing wrong. And I was like, oh God, I don't know what he's going to say here. And so I got back on the video and he said, well, you can see that what's been going wrong for some is the choppiness, and the more convergent type strategies have created more choppiness within the trends. So CTAs need to be longer term and have longer term exits, not to avoid some of the whipsaws. And I was like, oh, thank God, because I'd already done that. And I thought, okay, yes, over time, maybe there will have to be a further lengthening of these parameters, possibly. And maybe at some point in time, we say, this is ridiculous. We can't link them anymore. But short of that, I don't want to get rid of my diversification. I don't think my taking small losses is going to go out of style. Trading, so I don't know. I think the fundamental things that I do, I don't see them change as much as just a nuanced approach to maybe lengthening or shortening parameters over time. And that's why I think, I posted these articles on human beings loving complexity. Smart people like complexity. And I think that's a challenge that faces people when you get in the business and you have the fast computers and you have the knowledge to sort of say to yourself, stop right there. I'm not going to go beyond one entry, one exit, a stop loss. Okay, maybe two exits or a filter with the entry. That I think is the dilemma, because then at some point it starts impacting your sample size.
I mean, I think what Derek raises is a really, really critical point. First of all, I completely agree, Derek, with your infinite investor. I was actually talking to Richard about a month or 6 weeks ago. We were talking about some new material we're working on, and I actually referred to that exact point about Jim Cars and the infinite game essentially, and why trend following probably should be renamed as the infinite investor investment strategy. So I agree with that. But I also think that I think you raise a really critical point, because I think most firms have a tendency to not want to stray away too much from what they're doing. Jerry just expressed that. I'm sure we at Dunn have the same sort of limitations to how far we're going to stray away from what we've been doing for 47 years and so on and so forth. On the other hand, I think the only way you could possibly do it would be to continuously bring in new talent. Meaning, I think if you look at most research areas, once they've been with a firm for a number of years, I think we end up thinking in very similar ways. Um, and so, if I look at Dunn's history, I think one of the biggest changes we discovered and we made was actually when we brought in our current head of research many years ago. He came from a hedge fund. He had nothing to do with trend following before joining Dunn, and I actually think that allowed him to think outside the box, even though he liked trend following and the concept, but it allowed him to think a little bit differently as to how you could construct, not just the signals themselves, but maybe some of the things that is associated with exits, some of the ways you manage your risk, etc., etc. But I think there is a big danger in, if you're not willing to take on new talent on a continuous basis. I think it's really difficult to really make big steps in terms of improvement. But I also recognize, in a sense, that many of the firms that we know today that have been so successful, they are successful because they have a very, very solid and sound foundation, and therefore you don't necessarily have to stray too far away in order to be successful.
I had a program issue when we were speaking last for maybe 10 minutes, and I want to say the following. I was speaking not a long time ago, maybe a month ago. I was speaking with a director of investment bank, and he is a big advocate of buy and hold strategy. And I said to him that I don't like this strategy. I don't trust this strategy, and we have 8% performance average in this, as we all know, and 50% of a drawdown. And this strategy is very risky in a crisis environment, and we have faced this environment. In fact, it was crisis 2008, 2020 crisis, the Great Depression, 1930, and some other crisis. So, and he said to me, okay, and if you are right, why 75 for all investments 75% of all investments in the world are in a mutual funds and in a buy and hold strategy? And I answered that I think it's because of a psychology of a people. And what do you think about that?
I think people like what works. And if the stock market stopped working the way it's been working and CTAs made more money and did well, they would flock to trend following. So I think it's rare to find someone who's going to agree with us. I mean, but I wanted to comment on Niels's. Yeah, so I think I agree with Niels, and I think that you could be right. One of us has to refuse to change, and so I'll be that person. I mean, I know I've spent 35 years trying to change, and I have made changes, but they usually almost always didn't work. So I reverted back to more of a core classic trend following. And I think if you told new blood, smart people, whoever, you said, hey, here's what I want you to accomplish. I want you to increase our consistency, make us a better firm, make more money, less volatility. But here's this idea. You don't have to pay attention to the open trade equity. If it fluctuates, we have these up and down drawdowns on these mega trades, on these outliers. Don't worry about it. And I think that they'd say, oh, you've just made my job a lot easier. There's really nothing I need to do. And so I think that that's my mentality, which is I've convinced myself not to care about that so much. But I'm totally a fiend on adding markets and trading stocks and everything possible to accomplish that lack of volatility and the diversification, but nothing else. And so I think there really isn't much for me to do if I'm going to adopt that position that the volatility of the open trades doesn't matter. I'm not going to solve that problem because I'm going to say it's not a problem. And so I do think also that I can honestly look back over my career and see how much more money I would have made sticking to the classic strategies without improving them at all since 1983, except having a longer term look back. So my experience has been what's cost me is not innovation. It's the opposite of innovation. Too much innovation has its own challenges and cost as well, in my experience.
I have said before that I see here the analogy with arts and different arts and martial arts also. And I have a martial art background and I know about what I'm speaking. And I want to say that we have, and I said this before, that we have such martial arts like karate, aikido, jiu-jitsu, and it's based on the track records of centuries. And we have different modern martial arts, and modern is not also which means better, because in modern martial arts they're designing for fighting on the streets and it's perfect here, like boxing or something like that. But modern type of boxing, maybe kickboxing, it's perfect for fighting on the streets in evenings with people who are under drunk and with the drunken problems. But if we are in a war, it must be karate or jiu-jitsu or something like that. So I think that classical way is the best way in all art, in all sciences. And when we are talking about improvement, it must be really good improvement. And I think it must be adding something to a classical way, to a classical base, but not changing the base. If the base that has really century proved track record effectiveness, century proved effectiveness is changed, we can change all the system, all this we can change the system, we can change the strategy, and we can fail after that.
I must admit, I probably am slightly different because I accept this proposition that markets are adaptive. So I'm a bit like Derek in that I sort of enforce a degree of adaptability in my models. It's a very slow method of adaptation, but what it's doing is it's not affecting my targeting of the outliers in any way, but it certainly is affecting my targeting of noise and mean reversion, which I think detract from that outlier signal. So when I find this significant increase of noise in my systems, my system design accommodates for that by lengthening the look back. It's a sort of a more fluid, continual basis of adaptation and replacement of models over the course of time, but it is a very slow integration of this adaptation into the process. It's certainly not something that's over 1 or 2 years. It might be over 10 years, a sort of a trailing window that slowly, progressively adapts my models in line with the fact that I think that markets over time do adapt. Diversification needs to continually widen to new market opportunities. There's this continual research done in relation to looking for new markets to diversify into. The testing for this influence of noise and mean reversion in my systems, that's sort of always keeps me occupied on a sort of an ongoing basis, and I don't sort of have a static solution that applies for all time.
I had a lot of my own research in different directions, and I made a conclusion that there are some fields where changing is very bad idea. Some fields in the market where we can't change the market, our strategies.
Look, if we didn't adapt, we wouldn't have gone for longer lookbacks. So, we all probably have done it over a long-term time horizon. Some would have viewed it as a discretionary judgment, but when I look at the quantitative data itself over very long-term data sets, I can see the necessity of that need to adapt.
Yes, but we must understand that this necessity is really a necessity, but not a desire to make money just.
I'm highly influenced by listening to smart people, and so I have opened up my eyes of what I maybe looking at some additional ideas, and I mean, honestly, a few weeks ago when we were talking, Arthur brought up this idea of trading the short-term rates. And I had not traded the short-term interest rates, euro dollar, short sterling, Euribor, etc., in many years. And he just made this case for it. I'm like, oh yeah, you're right. So I can't tell you how often I've gotten in trouble taking things out of my portfolio. So I'd have this good reason to take it out, and then I would just get burned, which is like a rookie mistake, right? I'm dedicated to adding markets, but somehow I could convince myself to take off a market or two. And so I'm compelled by people saying things that fit into my trend following worldview. So I'm not too closed, but I do think that the way I look at the markets, which I've expressed a lot, many different forums, it does really limit. And I think to some degree, if I explained all of this to my mentors, I'm not even sure what their response would be. They'd say, oh, wow, 35 years later, you trade almost exactly like you've always traded, like we taught you, except you're just longer term. That's weird. And I thought we would have done better than that. Um, but that's pretty interesting that you really haven't changed very much. Or they could say, well, by moving your parameters out so much, you're not even doing anything close to what we used to do, and it's nothing we would really tolerate. I don't know if I'd get a positive response for my adaption, because I think to some degree, in hindsight, when we were taught trend following, I bought it hook, line, and sinker, but I think what we were really taught is more systematic approach to markets, which could be trend following or really even shorter term trading than we used to do in the early 80s.
I think Jerry and Richard both brought up interesting things. I think I sit in the middle. Yes, we do adapt to the market situation, and it's very slow. I think that the best way to think about it is Bayesian. I know I throw out these terms, but basically, you have this very long track record. It's going to take some very good evidence to the contrary to change what you're doing. And if you do change it, you update only a little bit. And I think that the issue with removing things for us, if we add another market or we add another system, say a time frame or whatever, this is going to stay there. And how we rebalance those weights as things are changing is really kind of using that slow progression, slow burn. It may take months or years or never change those parameters. But I'm never finding myself to have the urge to pull something out. If you've researched it well, you understand it's a good option, you can leave it in there, and every dog will have its day. You don't know when that day is, and that's just the necessary evil of our business, which one will capture the outliers best, or where those outliers from which markets they will come. So I think that that's a danger because you're removing that potential place where you will get that opportunity, and then we have all of this research behind it. So how much bad result is it going to take for me to take it off when I knew we had thousands of trades to put it in the first place?
And as far as adding markets, I mean, I've added so many markets over the years, and I've never once did a back test on that market before adding it. It didn't have data, possibly. It was a brand new future, or I didn't care. I was going to add it. It was different. I was going to trade all the markets with the same systems, so I didn't even need to test it. I wish the rest of you guys would get busy on trading individual stocks, because it's a lot easier to say, okay, I'm going to trade all the currencies. Oh, and I just added some cross currencies back as well. I hadn't traded some of the non-US based currency markets in many years, so I just added some of those back as well. And the back test was horrible. But then I'm thinking, okay, yeah, the back test over the past 10 years in the grains was horrible at one point as well. So, but I need help on stocks. It's easy to trade all the commodities and all the currencies, but looking at all the options you have in the stocks, and I only want to trade 20 or 30. It's really hard. It's too many options. I vacillate back and forth of how to put together this portfolio of stocks that I want to be somewhat permanent and not keep switching them in and out like a traditional manager, but I'm going to apply my system to this sort of fixed portfolio of equities, and I struggle.
I want to say two very good phrases of Niels from Systematic Investor Show. That phrase number one, Niels said, when we look at a portfolio of markets we trade, all of them have ability to move surprisingly big moves, which we did not see 5 or 10 years. And another, must find this, I liked very much. Phrase of Niels, second phrase of Niels about changing the strategies, and he said, people ask why we not change something in our model that will give us profit in situation like 2018. We answered, of course we can, but if we did it, we did it as a code because long-term performance is not like February 2018. Very good phrase. Long-term performance is not like February 2018.
I want to jump on something that Jerry said, and I think it's particularly important when you talk about expanding to emerging or frontier markets where you don't have that data. And I will include China, where I was implementing these types of strategies, and there was limited data at the time. And I think that the same could be said for cryptocurrencies. But the fact that we know that these things work allows you to kind of have a research backstop or a statistical backstop, because these are also financial markets and that we're targeting something, this phenomena that is repeatable. And that allows us to add more markets earlier, potentially, than someone who's doing relative value trading in, say, these frontier or emerging markets. They won't have that kind of basis to understand how that model might produce something, or more complicated models. The more complexity, the more you kill your sample. And then if you imagine you have only 3 years of data, 1 year of data, sometimes it's the new launch of a new product, you have zero data, then you really have a very structural way to look at things and have confidence to implement where other people may not.
Great point, Derek.
I think it comes back to also what Derek just said and what Jerry said, adding markets without doing a back test, et cetera, et cetera. It kind of reminds me what Richard Dennis said to Jerry and me when we did the podcast with Rich. At the very end, he said, well, the trend may be your friend, but the rules are your guardian angel. And I think deep down, that's what it all comes down to. We have so much belief in the process of what we do, the rules we follow, that we don't necessarily need all that, research done to add certain things, as long as we stay with the fundamental principles of trend following. And if you think about how strong that is, I mean, Derek just made the point that you might need a lot more data, a lot more testing for certain strategies, where we might say, well, actually, if it works on corn, it's going to work on, many other things. We don't even need to do, a lot of testing to prove that. I think that's probably where we failed as an industry, and why we may not, have a more favorable reception with investors, and that is they simply don't understand. We haven't been able to clearly and convincingly communicate the true value or the solidity of the foundation of trend following, and I think that's what we should do.
I like this very much, and by the way, last week we mentioned that we were talking about backtesting, and I said that data is never enough. So it's never enough backtest, of course, but backtest is not make very much sense for me if I don't understand how the strategy works. And I said that, of course, I don't know on a 100% basis how trend following works. I don't know this. But the facts I know about a trend following strategy is enough for me to have faith in this strategy. And I have said this many times, to have faith in the strategy. And if I have a faith, if I believe in a strategy, of course I will follow my rules.
I think that the point about the industry and explaining why trend following works is extremely difficult. Some people can attribute it to, say, behavioral economics. Other people's, especially in commodity, could say, okay, it's a liquidity premium. You're getting it from the hedgers who don't have economic, say, profitability that necessarily needs to come from the futures position itself. They're willing to drive the price and they're insensitive. But if you look at the other side of things, when you look at an equity manager or a buy and hold, because everybody's holding it, everyone can have a losing day and they can go to the bar and sling their sad stories. But because, proportionally they all lost money, everyone feels like it's okay. And I think that this is something that we do need to try to figure out what it is. But because it's this kind of like rare occurrence and it's kind of mixed up with all these different factors and things, to come up with a very clear and concise story that says trend following exists because X reason, at least in my research, is near impossible.
And my research is that I have said it before, that I have said it today, that I'm sure that trend following works because there are some rules, some laws of nature in general. And if we look at it, it's when we look at mountains, even looking at mountains, I can see the same laws that leads to work trend following strategies. I see flat periods and I can see trend periods, periods of big changes, even in mountains.
Oh, so Richard, I wanted to ask a question. Does the serial correlation found in the data being the reason that we can prove that the data is responsible for this edge, these profits, these outliers that occur? Does that run counter to this idea that we make money for any other reason, like we're taking money from the hedgers? Do both of those ideas exist, or there's this mysterious thing in the data and then nothing else can exist along with it?
Yeah, look, from how I've understood it and the research I've looked at, I'm tending to sort of follow more the Andrew Lowe approach to trend following, looking at the market as ecosystems or different behaviours of different participants. And these outliers that we catch, there is a strict quantitative reason why there is serial correlation in the series that we trade. And this is this non-linearity that we've discussed. And that is because of what we see as positive feedback in the tails of the market distribution of returns. And a positive feedback is where the participants in a system, it's not only their individual behaviour you've got to be concerned with, it's the impact of the neighbours' behaviour that create a feedback into the system, so that the outputs of the system then feed back into the system, and it creates this positive feedback or this amplification of the signal. Now, when the Bill Dreises and people like that talk about the enduring nature of trends, it's because of this serial correlation in the price series that leads to these price extensions. And that is a physics principle. That's due to this physics, this positive feedback. Now, alternative methods that use predictive methodologies, they sort of can be classed in this bucket called convergent methodologies. That is another form of serial correlation, but that is not a serial correlation in terms of price extension. That's a serial correlation in terms of frequency of trade event. So those strategies that apply the predictive method are looking for a situation arising from a market's tendency towards equilibrium. The areas that we're looking at, the tails of the distribution of returns, is attributed to a market's tendency to move away from an equilibrium. It's a market's tendency to change. So you get these different phases of the market environment, and in the tails of the distribution, we're getting this positive amplification. That's what causes capitulation tails in market moves when trends get serious, this extension of the price data. I can see that quantitatively in the data itself. You don't actually need to assign it to a particular reason, such as a behavioural reason or a psychology reason or the hedging influence, because there are multiple reasons for the actual causal drivers of those events. It could be a tsunami, it could be an endogenous event, it could be an exogenous event such as a pandemic. All of these things lead to this positive feedback where investor behaviour starts in this divergent period of the tails. You get this synchronous behaviour occurring. In an equilibrium, however, you get a dissipation of synchronous behaviour and you get multiple behaviours. So it's this synchronous behaviour where everyone's starting to do the same thing. You get this amplification of the signal. And that is exactly the reason we get this nonlinear extension or this nonlinearity. So the nonlinearity in our equity curves is that's at 5% or the 10% of the move, the 5 to 10% of the move. It's this nonlinearity. All other times it's linear. And under a linear scenario with serial correlation, the moves are much less significant or material in nature. That's why convergent strategies have a smoother profile, but they have lower returns. The nonlinearity of these extreme anomalies through this synchronous behavior and the positive feedbacks create these supreme returns if we're fortunate enough to catch them. But they are unpredictable in nature, and that's why we need this extensive diversification.
Very good. This reminds me of something I was thinking about this week, and I think I've been in a lot of client meetings over the past 35 years, and I just wish you would have been with me, because this is another way to kind of talk to clients, which is, hey, what we do is really interesting, and let me unpack some of this for you, and it's very deep. And I think the really quiet and smart people, who you and Derek, for instance, who I've run into in this industry, they use that intelligence to add something else to trend following, to make it different. And you guys talk about it in terms of, hey, let's go deeper into the classical trend following. And I think clients would say, wow, I had no idea. This is amazing. When I talk to so-and-so about their program, we spend 5 minutes on trend following and then 55 minutes on all the bells and whistles they've added to it that smooths out the problems with it. And so, yeah, I mean, this is why this whole Clubhouse thing has become so much fun for me, is because you guys take it to a really, really fun, deeper level. So keep it going.
Well, let me help with that, because I definitely want to tag on what Richard just said. I mean, he's definitely talking about this complex adaptive systems, and I think that the property of emergence and the feedback loop is definitely what creates this. And so, thinking about the narrative aspect to the client is one part, and then also easy examples to explain how it does create trends is my second part. So, because so many endogenous or exogenous events can cause the trigger for us to change phase from the linearity to non-linearity. It's hard to string together a consistent narrative, and we know clients, they love narrative, they love that consistency. When they can see that idea repeated over time, they get it, or at least that's my experience. I've probably had a lot less client meetings than Jerry. So I find that that's quite difficult, because if you say this time it was a tsunami, but it caused that effect, and then last time it's say COVID or something like that, or maybe it's just there's a lot of hedgers in this specific market, and it was the weather that allowed this thing to get out of control. But the best example I think that people understood and was highly publicized was in fact GameStop, and as tenuous as that sounds, is because there was a feedback loop that was activated after a specific point where people were forced to do something. And it caused them to feedback on themselves as those participants were made to move. And that is what's happening. Whether the trigger was these people on Reddit or whether the trigger is weather, it doesn't matter. There are these sorts of dynamics. There's going to be some kind of barrier, whether that's where our breakout point is or not, that does trigger this change from linearity to non-linearity.
I'd like to bring up the work from Friedrich Hayek, an economist from the from the 50s perhaps, and his contribution to economic theory is that the price system is a fundamental information device across society. It's so relevant to have a price system because you know what's lacking and what's abundant. So when we look at prices in the market, we have the best information available of what's lacking and what's not. I think trend following works so well because we don't pay attention to anything else. We just take the information that prices are giving us, and as this information is smoothly being spread across market participants, ever more participants get in the market or get out. I think this simplicity is what's behind our performance.
Yeah, another thing that George brought up on Twitter was bringing Mark, I forgot his last name, but he's a Yusko. He's a proponent of Bitcoin, getting him on the podcast. He has this, I don't know, he had this one line recently where price is a liar. And I think that, and so George's idea is, well, you price followers, it would be interesting to hear you debate this guy who is pretty famous and in rebut him saying price is a liar. But I'm not so sure that price doesn't lie. I mean, because look, 60% of my trades are losers, and I don't think that it means a great deal for the market to close on its high or close on its low. It probably has nothing significant day to day in terms of a long-term trend. So I think it's at the same time, price doesn't always tell us what's happening, and it gives us misleading hope and information. Wrapping a trend-following system that only looks at price around these markets can still be better than anything else.
Well, and I know Mark, and I was kind of curious about that comment because I was like, compared to what? Because at the end of the day, price is what price is. It doesn't matter whether you think the value of a product or a commodity is X when it's priced at Y. It is what it is. So the question's moot.
And he was trying to make this point, let's stay in Bitcoin, even though it was at $30,000, because this price is a lie. It's going to go up. And my point is, well, I'm going to stay in Bitcoin because hypothetically, let's say, my trailing stop has not been hit. But I'm not really going to call price a liar or not a liar. Sometimes it's going to get hit at the wrong time, and then sometimes it's going to rally and go up to 40,000, and I'll have stayed in that piece of the trade. So I don't know if liar is even relevant. It's a good soundbite.
And I think that the way I see it, yes, price does reflect people voting with their pocketbook, with the information that they have at hand. But that information is absorbed not instantaneously. Otherwise, price would move up in stair steps. As soon as new fundamental information that repriced whatever is Bitcoin, it would move instantly up to the new level, whether you want to use the stock and flow or whatever pricing model that you're using. Although I think that this type of thinking comes more from value guys, because they have an idea of what they believe is the fundamental value, and that's the real price. And the price is the laggard because it has not assimilated all of the information that they have yet. But if the market never does, if they're never proven right, then at the end they still have a loser. So there is a slow infusion of information into price, and because the world changes day by day, the amount of information that needs to be absorbed in price by people taking trades is also changing. So I wouldn't say it's a liar, but it's a very good representation of what we have, because the smartest people in the world are interacting with that marketplace every nanosecond. um, but do you have that 5% of information that the market isn't incorporating? Is it 10%? Is it however much percent? And you really would have to know something very significant. So I would think that, in my mind, just thinking backwards, if I were to try to find information asymmetry, would be in like less liquid, less followed single stocks, frontier markets, things like that, where your fundamental research could find something material. If you're looking at something like the S&P 500, I mean, you have billions of eyes on that thing every day. The chance that you're going to find a proper mispricing is really small. So I would say it would probably contain 99.9% of all information known about that index and those 500 companies.
Yeah,
Yeah,
look,
but I don't think it depends on information asymmetry. If people need more, I don't know, corn, its price is going to go up. And after the fact, we will know the reason. We will know there was a productivity drop, or less crops for any reason, or I don't know, whatever. It doesn't really matter. What does matter is that the price is going up, and we have reasons to believe that's going to continue to go up because of all the reasons you guys just talked about, all of these complexity and how complex systems evolve, and that's our best shot, and it's good enough, and that's it.
yes, I tend to think that when this efficient market hypothesis refers to the markets being a huge supercomputer, that all of these rational participants inject their decisions into the market, so at all points in time, price is an exact representation of the total rationality of that market. I think you can replace that notion with imperfect information. So you can separate the market into two domains. There's the domain of uncertainty and there's a domain of knowledge. And I think that the predictive methodologies are fairly successful within their knowledge domain. But I think that trend following models are particularly successful in this uncertain domain. And this zero sum game that is the markets, I believe, requires, when the predictive models fail, the trend followers, with their uncertainty, they win. And it's a battle between uncertainty and knowledge, I feel, based on the fact that this supercomputer that is the market is basically comprised of sort of participants that are imperfect. They're not perfect rational participants. They only have a domain of knowledge that is limited in nature, and it's not totally encompassing and can cover all aspects. So that opportunity that resides for us lies in the fact that the predictions will fail in these particular regimes which go beyond the thresholds of predictive modelling.
I will touch on something, Bruno, and then what Richard said. So, what what the example Bruno mentioned, I believe that would only be true that you could call price a liar, say ex ante or before it happened, because the journalists and the media will come up with some kind of answer ex post. So you can only call price a liar today if you know it's going to be wrong and the price is going to move up tomorrow, which, as Richard said, means that you have some more perfect information or perfect information. Um, and then if we think that price is imperfect information, is you can imagine that it's only 60% correct or 55% correct. compared to what your personal research has been. And is your research better than that or not? How are you able to price that? And I do think that it is pretty efficient. A lot of smart people with PhDs or whatever are coming at this, so it's going to embed the best information those people have because they have to put money on the line. And that does mean if you are following price, you will have the best estimates of the collective of people who have interacted with that market. It may not be perfect, but it's a higher percent chance than maybe you going off by yourself and trying to do everything on your own. And if you make a single mistake, well, then your entire basis for the trade is completely wrong.
Agree 100%, Eric.
Wasn't Mark just referring to the price of Bitcoin, by the way? I didn't see the interview, but I think he was talking about the price of Bitcoin. And if he did, I mean, he could be right, because who knows what the price of Bitcoin should be.
That's right. He was talking about Bitcoin. Now, does this mean, Derek, that the better that AI and ML get, that I can shorten my parameters, that the trends will be more less choppy because the smart money will come in, and due to AI, they'll know that this sell-off should be bought by the dip, and then when the market turns around, the market will be smarter. The price is better because of this advanced technology, and that I can shorten my parameters and ride the trends closer.
That's a very good question because I do trade cryptos and I do trade traditional CTA, both with trend following methods. And I do find that in crypto, it has a faster, I want to call it a metabolism. And because the participants are different, as in fully electronic, it doesn't have the traditional passive flows that we see in traditional markets or hedgers or commercials who have these kind of longer term things. Shorter term signals do tend to do better, I guess, than you would say if you took, say, the same signal and you applied it to a traditional asset class, whether that's a stock index or a commodity. It might be unprofitable, but you will see that they actually become profitable in crypto, and that might be part of it. Going on to AI and how to use it, I am not that great at it, but I do believe there is a level that is voodoo where people create black boxes, and I do find that there's a place for it in there. And the amount of things like for on-chain data and stuff like that may have influence in the price, but that would be considering it's almost like fundamental data. If you're saying that an AI is going to know specifically this one to buy the dip or something like that, to me that's a bit sketchy, or at least maybe beyond my pay grade for the understanding of AI. But I don't see that happening anytime soon. I think the reason why it's faster is more about the types of participants and the lack of the slower moving types of participants than it is specifically AIs in the crypto.
I was talking mainly, I wasn't talking about crypto necessarily. If AI gets involved in the Swiss franc and corn, and the trends become smarter, and now we get these convergent sell-offs for no good reason, and the trend resumes, will AI ML stop that in corn? They'll say, yeah, go ahead and sell it off. Corn's going up according to our models. And then this would allow me to sort of go back to trading shorter term because the market itself has gotten better and smarter, and people will step in and on some of these sell-offs that mean nothing.
I tend to think that convergence sort of destroys the divergence signal. So the more AI you get in the market, the more convergence you get in the market. And I think what that's going to mean is we're probably going to be progressively stepping out further and further. But where I have hope is that AI and is particularly effective within convergent regimes of pattern recognition, predictive modelling, all of these things that rely on the quick analysis of large data sets and identification of patterns. I don't think that that's actually competing with our space. Our space is in the land of uncertainty, and that's something we're here to stay for the long term, because these complex adaptive markets will always have these domains of uncertainty because they're continually adapting. So knowledge is never full. It's an always sort of a growing, a cup that never fills. Markets always adapt. Uncertainty will always exist. So trend following, I think we're fairly safe, and I don't think we're going to be outcompeted by AI in our particular space, but certainly within the convergent RenTech space, yes, AI, I think, is going to dominate that domain.
That makes sense, given that, I think essentially what you're saying is you don't see AI, ML embracing long-term trades. Why would we do that? We'll have this knowledge to hold on to trades much shorter term and leave the long-term stuff to the trend followers.
AI aren't patient like we are, Jerry.
That's right.
I like very much phrase of Niels, opinion of Niels, that if the environment will change, and then the phones, which is based on machine learning, will blow. And I agree with it, fully agree with. Trend following is deal not only with the past, it is adaptive, and it's dealing with the unknown, uncertain future. And as Neil said, AI phones, they work only with the past. They not prepare in a good way. They are not prepared for an uncertain events, uncertain.
I mean, just thinking out loud, I think that at the moment, if we look back the last 10 years, you could probably say that sell-offs have been shorter in time. They may have been deep at times, but they've been shorter in duration, and so on and so forth. And we may think that, okay, maybe that's to do with AI and machine learning, and they're just coming in and buying the markets up because that's what they've learned to do. But I mean, maybe just thinking out loud, this has nothing to do with the technology. It has nothing to do with machine learning. This has something to do with the fact that in the last 10, maybe 15 years, central banks have just simply been successful in managing the economies. There's been fewer busts and there have been fewer booms in the economy. GDP has been incredibly stable. I think Quantica has done some analysis on returns of trend following in relationship to the level of interest rates. The higher the interest rates, the better the performance of trend following, and so on and so forth. So maybe we're just concluding that this has something to do with the technology coming into our space, but it may have nothing to do with it in reality. And as soon as they lose control of the economy and we get back to kind of what we've seen in the past, then a lot of this will go away.
I prefer Neil's story. But in the end, we all have only one data point to compare this. We have one episode of AI increasing its presence in the markets, and we're concluding that the lack of trends is due to this event, but it may well not be. I do believe more in Neil's version of central banks interfering with markets and killing trends. It's the so-called Great Moderation period in the last days.
I want to mention another very good phrase of Niels that he said, but not designing a perfect system that delivers positive monthly returns all the time. We feel that our approach more equipped more for those things that can come in the future. We understand that future cannot be the same as the past. The great phrase.
Seth, do you want to comment on what we've been talking about recently? I need to sign off here in a couple of minutes. So I'll give you one chance if you want to take it to be our last speaker.
Yeah, thanks. So when you were talking earlier about you wish there were more trend followers in the stocks, I was thinking the same about crypto, and I was happy to hear Derek's comments about his experience trading crypto with trend following, and I was really happy to hear that he was looking at shorter time frames than traditional markets, because that's been my experience as well in my testing. And I was kind of scared to say that, kind of scared to admit it to anybody. So I'm glad Derek was brave enough to mention that. And just excited to hear that someone else has kind of come to the same conclusion from their research as I have. And trend following is doing really well in crypto right now. I'm back to new equity highs today, with Bitcoin still being down pretty significantly from its high. I think diversification in crypto is the thing to look at right now. I think everybody's focused on Bitcoin and maybe Ethereum, but there's a lot of altcoins that are trending really hard and moving big, and they're pretty smooth uptrends. I mean, I use a very, very tight initial stop, and every trade I've put on over the last month is still open, except for one, I think. So I think just like we should all be looking more at individual stocks, I think a lot of people would be well served to look at crypto. It's really set up well for trend followers. With the market never closing, you don't have to worry about gap risk. With the fractionalization of tokens, you can take really small position sizes. But yeah, I'm just happy to hear I got a fellow trend follower looking into the crypto space a little deeper than just the big well-known coins.
Let me just finish by saying thanks for everybody for tuning in, and we'll do it again next Friday. And gosh, I love my Saturdays and Sundays off, Seth. I don't want this market to be open all the time. But I will say it's a good thing to pick up next week, because I don't agree that we should have a separate system for certain markets, and we should use what works best with all the markets. And I could not allow myself to have a shorter term system for crypto. And I don't think that it'll end up, I think this particular period may look great for short-term systems for crypto, but my great long-term systems that absorb a lot of fluctuation and sell-offs will, in the long run, over the next 100 years, work just as well in crypto as it does in the other markets, and better than the shorter-term systems. But it's a philosophical, I'm just trying to get you all riled up so you'll tune in next week and we can talk about that. And then my other comment about crypto would be, some of us need the futures to exist, and we prefer the futures. And then plus, it just seems to me that a lot of these crypto are highly correlated, and I'd like to see them start not being so correlated, liquid, non-correlated, and have a whole sector in my portfolio, like the currencies, which I trade them all. They're sort of correlated most of the time, but I'd like to see something different going on with Ethereum and Bitcoin, and to where I could really call it a separate sector, and it'd be wonderful. Anyways, thanks everybody, and thanks for recording the previous two, Richard. I don't know if you got today's, but
Yep, got
thanks for
this
doing
one.
that. We appreciate it, and everybody have a good weekend. We'll talk next week.
Thanks, Jerry. Thanks, everyone.
Thanks, Jerry. Bye, everyone.
Thanks, everyone.